Let's see. Let's go. So today we're going to have Michael Ball from Edward Jones Financial Advisor. He is a former Navy. He's in the military, retired. And I would like him to help us understand a little bit more about what's going on in the markets. Michael.
Thank you, Zena. I appreciate it. The majority of the time, there's going to be talking a little bit probably about GameStop, because that's the big question that's got everyone kind of like, what is that? What happened and why? And then talk a little bit about the 2020 outlook and some of the Edward Jones view of things. But I'm going to share my screen here real quick. And this is something that I found off of a website called Virtual Capitalist. It's the best single page that I've seen so far in terms of what's happened in terms of graphics. As you can tell, it's very graphic oriented to look at, and that's very much easier on the eye to explain, because this is a complex thing that's happened. So, starts off where, hey, crazy world of games stonks. Well, if anybody doesn't know what the word stonks came from, if you follow Twitter at all, if you follow Elon Musk at all, he's the one that started with the word game stonk. And hence the word stonk. So what's happened in the social media world and on Reddit and stuff, the word stocks has been replaced with the word stonks. It's kind of a way to kind of add a little spice to the mainly boring world of stock market stuff. So what happened? What's going on? Well, in order to first do that, you have to understand who the key players are that's going on. And as you can see, there are up to 6 different players here that are playing. I'm going to focus everyone here to the top section. GameStop. GameStop was the stock in question that's being done, okay? That was being traded on by the stock market between hedge fund and the people on Reddit through the app called Robinhood. Okay, and then so what happens is the hedge fund guys, they sell stocks short. They short a stock. In other words, what does that mean? They think GameStop was not going to do well. Okay, I think GameStop was going to be really not doing well going forward. Why? Because if anybody's been to the mall, that's how GameStop made their money. They sold via discs, CDs, your PlayStation games, and whatever, they sold it. And so what happened is, going forward, what's happened is, if you're anything like my 12-year-old, he downloads all the games. It's all via download and the like. So that's, so we don't think, a lot of the hedge funds do not think that GameStop going forward is a viable business. So they short the stock. Now, what is shorting? Shorting is when, and I'm going to read this verbatim from down here, i.e. short selling, is when a trader or investor borrows a stock and they pay a rate for that to borrow the stock from somebody else, and then they sell it with the expectation that the price will drop and go back down, and then they can buy it back at a lower price. Example, they thought the stock would come in, say GameStop at one point was selling at 20. They sell it back and they borrow it, and then they buy it back at 17, and they pocket the difference of $3. And that's pretty much what shorting does. Now, the risk there is this, and this is what the Wall Street Bets guys were doing. What was happening was the Wall Street Bet guys were saying, we noticed that these hedge funds were shorting the market. We're shorting the GameStop. So rather than letting the GameStop keep going down because no one was buying it at a lesser price, they were buying it in mass, lots of money, buying it by a lot, and they were covering and bringing the price up, artificially inflating the price. How do I say that? Because here's GameStop at one point was at $19. January 28th, it goes up to $483. Okay, so within a course of 2 to 3 weeks, it goes up by thousands of percent. I don't know about you, but that seems like a bubble if I've ever heard one that's out there. And so what was happening was these companies, they had borrowed that GameStop stock. The people that they borrowed it from saying, hey, I want my stock back. Because they wanted the stock back and the price was so high, they had to end up paying the $483 to actually physically own the stock and give it back to the other individual, to the original person that originally owned the stock. And so that's what's causing all these shorts to lose money. A good example here is if you go down to January 25th right here, this Melvin Capital Management, they recently in January closed out their position on GameStop. What was their price? They lost 53% of their value of what happened. Okay. So that's kind of what's happened in a nutshell between GameStop and the like. Now, the difference is what typically happens with hedge funds. What's the purpose of hedge funds? Hedge funds try to outgain the market by a lot. Okay. I try to do a lot of it in terms of making a lot of money for a lot of people. They try to beat the market by double digits historically is what they try to do. Now, have they been successful doing that? Not really going forward. So that being said, what's happened with these hedge funds is these hedge funds have not made a lot of money specifically on GameStop. Well, hedge funds typically make their money in a lot of the ways by shorting these different stocks. You heard about GameStop. Here's a couple other ones that you're going to hear about. AMC, it started at $2 and went up to 20. Now it's down to 14. Okay. BlackBerry at 7. Now it's up to 15. Nokia started at 4, went to 5. What's happening is in the between the social media realm, which is the new world we're living in, of social media and the stocks and all that, and using this Wall Street chat room, if you will, Wall Street Bets. Anybody can go to it. Anybody can look at it. If you have a Reddit account, go look and follow it. You'll find some really interesting discussions, we'll say, with what's going on to do that. And so what's happening, it's kind of there's this paradigm of it's David versus Goliath. Hedge funds, because they have multi-million-dollar people, they're being Goliath, and the Wall Street bet guy being the average guy, or average individual, sorry, using Wall Street bets. And it's kind of this back and forth between the two. Now, what's happened typically, like all things when you do with social media, it gets really hot, it looks really cool, everyone loves it, and then it just kind of peters out over time. Okay, and that's kind of what the Wall Street bet thing has happened, because if you notice, it started at 483, and then by the beginning of February, it was down to 225, and it's already down to back down to $94 today. Okay, so a lot of people made money if you're willing to buy the stock and then get out before it gets back down. But the problem is the volume that was traded during these high points here, a lot of people lost a lot of money. Okay, now there's another side to it. Okay, that's just one segment. The next piece to it was how the guys from Wall Street Bets were able to do this. What are they using? Well, they're using the Robinhood app. Why does everybody love the Robinhood app? It's free commissions. It doesn't cost you anything to trade a stock back and forth. But, and I'm sure Yazani can back this up, anytime it's free, who is or what is the product?
Data.
The data and the individual that just wanted to buy the stock became the product. That's the problem. And that's the issue why you see, if you notice the sixth player here is the SEC, that's why the SEC is looking into it. Because if it's free, that means somebody's the product. Who's the product? It's the actual individual Wall Street Bets. It's the people on Wall Street Bets that are doing it. Okay, so what happens? Now the question is, what's Robinhood doing? How are they actually making the trades? Well, how Robinhood makes their money if they're not charging the people in Wall Street Bets any commission fee, they're paying this firm called Citadel Securities is paying for Robinhood's trades. And they're paying for the trades to do that. And that's how Robinhood's making their money. They're selling. So a good example would be, say, if I want to trade GameStop, I go to Robinhood, I buy the stock, Robinhood turns it around and sells that trade to Citadel Securities. And that's how they make their money. And then Citadel Securities, what they do, they're what they call in our world a market maker. Okay. And what they do is they work with other brokers to actually make the trade happen. Now, what they don't tell you about Citadel Securities is they also run a hedge fund on top of it. So they're going against, they're on the other side. So the guys at Wall Street Bets are selling to Citadel Securities. Citadel Securities is also doing the short. So they're making double their money on what's happening. So there's a natural conflict of interest there that's kind of happening, that's being worked through with the SEC and stuff like that. So it's one of those items that is a problem to say the least. You know, the other thing I will tell you that's happened with this going forward with the Wall Street Bets and stuff, who are, everyone knows who the hedge fund is, right? But who are the people that are the Wall Street bets people? Um, the Wall Street bets people historically, it's the average Joe. It's an average individual, okay, that's out there. There's some discussion of who they are. Hey, they're typically 35-year-old men, single, living in their basement, their parents' basement, doing their own thing. Then they're, but it's a big swath of people. It's just what's happened is you have what they call the democratization of trading. In other words, anyone can trade at any time. Because it's a new thing that's happening, okay? Um, we're just at the beginning of this process. This will get worked out to figure out what the rules and regulations are, to make sure that everything works like it's supposed to in an orderly fashion. Because what was happening was with Robinhood, because it's a relatively new company, typically when you do these type of trades, there's some type of collateral you have to have, okay, in order to cover the trade, okay, from Robinhood's perspective. And that's why you saw these restrictions being laid on, because there was so much volume coming in. Robinhood actually didn't physically have the money in hand to cover the trades that they need to happen. And it's not something that really you necessarily deal with, but it's more on the financial side, on my side of it. Now, who's the one requiring Robinhood to have X amount of capital underneath its belt in order to make sure the trades become liquid and make sure they're good? Well, it's this group over here over the SEC. It's the National Securities and Clearing Corporation. They're the ones that help provide to make sure the orderly fashion of trades. Okay, they're the people in the background that the average person doesn't know, but I do in the industry, because that's what we do. Because we make sure that they offer counterparty services and they make sure that things trade smoothly. Okay, that's the part that was happening. And when Robinhood couldn't do that, they had to limit, because they didn't have the amount of capital involved. They had to limit the amount of trades that were happening. Okay, that was there. And the problem was, if you were watching what was happening, especially about the last week, last week of January, the trading on Robinhood and everything was so volatile that it was hitting the circuit breakers in the market. The circuit breakers is stuff where you literally have to stop trading on the stock, so people can get their money out when they wanted to. And that's caused a lot of uproar. Why couldn't they do it? Why couldn't they do it? Well, the reason was for two factors. One, the stock was so volatile that the New York Stock Exchange, it was hitting the circuit breakers to keep it safe, to help protect investors from things going off the rails. And the second thing was Robinhood and some of the other companies that do the trading didn't have the capital to cover the amount of the volume of the trades that was going on. What did that lead to? That led to this over here in this Twitter account about AOC and asking about decisions retail investors and why they're able to free trade the stock as they see fit and what the difference is. And that's kind of what the big rub is going forward and why there's a lot of discussion. Now, the interesting thing I'll tell you, all politics aside, is the fact that Ocasio-Cortez and Ted Cruz agreed with this comment. That her tweet tells you there's probably something that needs to get looked at and needs to get addressed, okay, going forward. Now, today the stock is down again. Stock right now, let me look at it real quick. The stock is down another 10%. It's down to 83.60 at this very moment in the markets, okay? So that's kind of what's happened with GameStop in a nutshell. I know that was a long explanation a little bit. I will stop and answer any questions anyone has at this point before I go into the next step.
Thank you, Michael. If anyone has any questions, yes, please feel free to unmute yourself and ask him. Thank you for that presentation, and that is a very good explanation of the simplicity behind it. It is much more complicated. This has been happening since probably forever with specific stocks. It just hasn't been mainstream. So just be aware of how that market squeeze works. And Michael gave a really good explanation of the players and who people are and why they're doing things. Anyone?
If not, I'll move on to my next one real quick and we'll go from there. And if anybody has any questions, we'll go on to the next one.
Great.
Okay. So this one is, I'm going to go through our real quick outlook, okay, for Edward Jones and what we think is going to happen, okay. This is going to be about 12, 10, I got 10 minutes left of the presentation, then we'll have to open up to any questions they have, okay. So what's driving the market right now for 2021? It's all about the vaccine. It's all about the vaccine rollout, okay. There's no question about what it is. And we're coming out of the stumbling blocks of the development of COVID-19, but things will progress. Household consumption will remain. We're a consumer-based economy. We'll continue to accept that'll continue to be the backbone, but how we do it will change. Okay, there's been some fundamental changes to the markets with the labor market and stuff like that. And how people adjust. There'll be more, I will say, a difference between work and life balance has changed. More people working from home, more flexibility. The data that's coming out is showing that people are actually working more, not less, with working from home. And it's kind of driven up productivity quite a bit. And that's kind of been the aha moment for a lot of companies. At the same time, there's concerns about innovation and people talking, the old discussions around the water cooler discussions that come up with new ideas. How do we keep brainstorming and keep moving forward? That will get worked out as we begin to look at some of the changes in the vaccine gets done. In Florida right now, it's the priorities for 65 and older. Full disclosure, I was able to get my vaccine shot. I got my second one yesterday. I got it simply because if nothing else, what they don't tell you about the vaccines that are currently out there, especially the 2-shot ones, once they break them out of the deep freeze, they have to use them that day. The one I got, my second shot I got yesterday, they broke it out of the freezer at 9:10. It was in my arm by 9:30. If I hadn't been there to take the shot, it expired by 2 o'clock that afternoon, and they would have had to throw it away. So that's part of the complex thing. And you're trying to do it on a mass scale. Okay, you're thousands of people a day, limited areas to do it, bottlenecks. That's the logistical challenge that people are talking about quite a bit. Okay, now the other thing I'll tell you is, despite all that, we're looking probably at the first half of this continue to fits and starts of things moving forward. We are in the middle of the next expansionary cycle. Okay, that does favor the markets over time with what's going to happen, and we are going to see, a strong economy. Okay, now that means the first quarter may be a little bit difficult, but the second and third quarters will definitely see growth over time. And the general presumption, as we talk to people for 2021, we're expecting a 4% growth for the full year next year. Now that's pretty good, because what you'll see here, as I look through the Edward Jones thing, this is the general growth, GDP growth since 2008 by quarter. It's been about 2 or 3% on average. It hasn't been that good. The average growth since 2000 is 2.1. It's been slow growth, a slow slog out of the financial crisis. We expect that to more rapidly be done to get that finished for the quarterly. And the interesting thing that a lot of people don't understand is, well, how bad was this worse than the financial crisis? The answer to that is yes. How do you know that? Is right here. The worst drawdown we had at any one point for the financial crisis was 8.4%. Within the second quarter, it went down to 31.4. Now that being said, it came back up, but we're still down for fiscal year for the calendar year 2020. We were down. I think the overall economy shrunk by 3 or 4% overall. Okay, so just want to keep that in mind for everybody with what's happened. The other thing I'll tell you is a lot of concerns about unemployment. What's going to happen with unemployment? At the peak, it was at 14.7. Last month, it was down to 6.7. That being said, the economic report going forward comes out tomorrow for what happened in the month of January for the overall rate is. That is something we look at. Why do we look at that? Because we think as part of this, quote, with the word we use in the industry, scarring of the economy, there are changes that are going to be happening. What do those changes mean? Those changes, like technology, become critical to us, okay? I'll give another example that we're looking at for changes, healthcare, how we deliver healthcare. I mean, how many times last year did you think you talk to your doctor over a video chat about your health condition? Hey, doc, I got a sore throat. That type of stuff is going on. Those type of things that are happening. E-commerce delivery, things along those lines. Those changes that happen. Now, there are jobs lost from that, but there are also jobs created from that as well. And the issue becomes is who needs to go back through the retraining or get retooled to help with this new economy. It's the rub that a lot of, believe it or not, if there's any changes that are going to happen to get those people back in training, it's going to happen locally. It's going to be through things like HCC that does it. Organizations, the nonprofit organizations that are typically out there, local here in the community of the South Shore, those will be the ones that help get those people retooled to get those jobs back. Okay? Because here's the job growth that's happened. We lost a lot in April, but then it slowed down by a lot. It's going to continue to do that going forward. So that's another aspect of the COVID vaccines as things get rolled out. Okay, but things will improve over time. There's a bunch of data in here. I'll send this out in an email to everybody to kind of give you the nuts and bolts of it, a little bit bigger business. Here's one that I like to look at. Everyone's worried about what's going to happen with the market. It's going to continue. Okay. Now here's the other thing that'll happen prior to the initial vaccine announcement for 2020. You know, here were the leaders in the market. Okay. But in the green, but in the orange, here are the leaders of the market going forward. What does this tell you? When you see financials and energy become leaders, that means you're at the beginning of a new market cycle. Okay. And then the next thing you see is the industrials change. Okay. Technology will still play a role in the markets going forward, we think, but we don't quite know for sure. And that's why you're seeing the markets doing what they're doing right now, because the markets are literally trying to figure this stuff out. Okay. With everything that's being said. Okay. Interest rates, and this goes back to Matt's life of interest rates. What you'll see going forward, we think, is interest rates will remain zero for a significant period of time. Okay. The days of the 80s of 5, 6, 7% on the bond market that you saw in the 80s, those days probably you won't see those for a very long time, if ever again. Okay, if ever again. Okay, if you just notice, we just started to come back up where we could raise the financial rates up a little bit higher, but then it came right back down. You're going to see this for at least the Fed says you're going to see this at least through 2022, 2023. Now, what does it mean for the local economy? That means interest rates for housing are going to remain low. Interest rates for small businesses are going to remain low. Okay, when you combine that with all the financial COVID support that's out there from the Small Business Administration, from the federal government that's coming down the pipe, there's an opportunity for small business to start up again, because they realized the small business got knocked flat on its back and struggled to come through. And there's been some loss, some scarring of it. But there is opportunity to do that because they're going to offer some very cheap rates going forward for us as local businesses. So look at that, talk to Mr. Nichols about that for your business, for loans and the like, Suncoast business and all that, because there are opportunities that are out there for you. Okay. And the other one I'm going to leave you with is, the one thing that's always out there, this is the unknown. There's also the global economic uncertainty. Why do I bring that up? If you remember, in the previous administration, China was very big, but then China got put on the back burner. As we come out of the economy, we start to get our bearings again for economy. China will come back as a member of the issues of front burner of how we handle with China and what we do with that for our trade deficits and stuff like that. So that's something to keep in mind. Okay. And the other thing to think about real quick is the debt level. A lot of people talk about debt, that $1.9 trillion package that the government's talking about right now, getting ready to pass. Here's where we're at relative to a percentage of GDP to our debt. We're over 100%. Last time we were over 100%, it was World War II. So if you hear the current administration talk about, hey, we're in a wartime footing, this is what they're referring to from a GDP perspective of how to get there, okay? Now, the advantage is we had huge economic expansion after World War II, the roaring 50s, the roaring 60s and all that, okay? So it eventually came down. Why they're looking for that future is because we hope that number will go down again as the economy expands out to account for that. If it doesn't, either way, what's going to happen if it doesn't come back like it's supposed to, the only way to fix the debt, which will eventually become a problem for us at some time in the future, we don't know when, but the general consensus is among economists and through the wholesalers I talk to, is you got to raise taxes. It's the only way to get the debt down because you got to pay for it. The average person in America owes, whether you're a newborn just born 10 seconds ago, or you're an 85-year-old, on your deathbed getting ready to pass on, the average person owes $134,000 of U.S. debt. Just to give you a sense of just how significant that is. Now, it doesn't mean it won't change over time as the GDP grows, but just want to put that out there to put that back in everyone's head for everybody. So what do you do? If you're a financial person, one, find your financial, make your resolutions for the year, continue to move forward, review your diversification for investing, whether it be real estate or for stocks and bonds, or if you don't have a plan, come talk to me. I'll be more happy to sit there and discuss what the plan is, especially if you're a small business owner. This is a critical time for you to come out of COVID. How do you set yourself up for success? There's opportunity out there for your business. How do we do it? Have a plan that is flexible and is malleable to the current environment we see. I'll leave you with this famous quote that I heard again, which was from Dwight D. Eisenhower. Plans are nothing. Planning is everything. Planning is everything. So keep planning, keep talking, keep engaging, and stuff like that. I'll leave it there for a couple minutes for any questions anybody has, but thank you for your time and opportunity.
Thank you, Michael. That was great. And I'm glad that you went over those graphs. It kind of gives perspective of, where we were, like historical, and where we are going and how we're doing. It's always nice to see data back up specific information. Anyone have any questions?
I do. I had one quick question.
Yeah.
So you mentioned that energy stocks are going to rise or rise. How do you explain that in relation to like ExxonMobil that showed the biggest? Is that energy in terms of oil energy, or is it new types of?
It's a little bit of mix of both.
Because Exxon for the first time reported a huge loss for the fiscal year ended.
Correct. They did because
they're
the
like
loss.
the logo for this whole oil in the whole energy industry. How do you explain that contradiction?
Yeah, sure. The first thing I'll tell you is the markets are looking forward, are forward looking. Okay, and so what you're seeing with Exxon and the increase in value is they're looking out 6 months. The market's looking 6 months. Okay, so they're looking 6 months out. People are going to be driving more. People are going to go out more and stuff like that. So therefore, the value of the company should go up. That being said, Exxon is one of those companies, along with a lot of the other energy stocks. Long term, you're right. They are probably on the wrong side of the trade in terms of energy development, especially with the new administration coming in and they're going green. The other thing I'll tell you is this: the younger generation is very much into going green. GM recently committed to going, to go away from fossil coal burning carbon burning to total EV by 2035. That stuff is trading. So the markets, if you looked at what happened to Exxon back in March, in terms of where their stock was and then where it is now, the markets anticipated that type of loss, and that's why you saw the drop that you did in the market and starting to come back, because the market said, yeah, we knew that was going to be a bad quarter. We predicted it, and it was, just like you said. But the markets are now looking out 6 months ahead, and that's why you're seeing the increase in the energy stocks, because it's trying to be as a forward-looking apparatus. So hope that helped.
Yes, that's great. I had one other quick question regarding real estate. I know that housing, residential is obviously on the boom, as explained earlier. But with all this working from home and it increasing productivity and possibly more people moving to work from home, maybe a lot of businesses going to give up their commercial leases and all of that. How do you think that will have a major impact on the market?
So there won't be an impact so much on the stock market. So in certain aspects of the stock market will, the real estate investment trust that will. So there will be some impacts there for the real estate investment trust. Well, I will say for the commercial real estate trust, yeah, that's part of the scarring and stuff. You're going to see the changes or that I was talking about during the presentation. How does that change? You're seeing a lot more people go to flex offices and flexible workspaces, or you borrow it. Like I think there's one actually up near the old movie theater on AMC in Gibsonton. There's that flex office space up there. That's kind of the way where people need to meet somebody in person. They go there for a couple hours, they rent the space, and then they move on. So that's kind of where we see things going on, but that is still it's still a story to be written, to be honest with you, about what the actual impacts are going forward. I know for myself, because certain industries like myself, we have to have an office according to regulations because of what I do as just an individual, as a stock trader and goal and financial advisor. We have to have an office by regulation. So some of that won't go away from my perspective. But overall, the conventional wisdom is you're right. There'll be less real estate needed to get that done. And that's part of the new normal that we're trying to bake in, we're trying to figure out.
All right. Thanks, Mike.
Yep.
Thanks, Mike. If anyone has to go, I understand about time, but we're going to stay and answer any other questions that you might have. I think this is a really important topic, especially when it comes to, our businesses, how we fund our businesses, how we continue to have solvency and can move forward. If you're in a bigger company, obviously that's also to know where the market's going and where your industry is like positioned. Especially, I know in marketing, it's really important for me to have my clients know where they're positioned and where they're falling in the scheme of things. Like, energy is changing. So where BP falls and where the green companies fall, it's super important to kind of know those things, even if it's not something you panic upon, but it's something that you're aware of, you have education on, and can move forward, and how it's going to affect your business. I mean, it can affect anybody, from a large company to a small company. Thank you so much, Michael. Anyone else? No?
I have a question.
Yeah.
Do you recommend, okay, so we purchased our home in 2019. Do you recommend that we would refinance at this point, since it's so early on in our mortgage, life?
That may be something that Matt Urbanowski will probably answer a little bit better for you. It depends what the interest rates are. So, I really can't give you.
Pretty low interest. We have a pretty low interest rate, but zero. I mean,
wait a little bit. Give yourself some more time to let it. Yeah,
that's better.
Yeah, wait a little bit. Let it bake in for a little bit more. And as things change, you may find you get a little bit better interest rate going forward because you're so new. There'll be a penalty associated with that refinance within a certain amount of time.
Michael, if I may,
Yeah.
Depending on what type of mortgage you have, there is no prepayment anymore. They did away with that. If it's a Fannie Freddie conventional loan, you at least want to lower your interest rate by 1%.
Yep.
To affect your payment, but then you have to look at your closing costs. A lot of times the closing costs can offset any gain you would have gotten by lowering that in your payment. There's some rule that you want to be able to regain that closing cost in a certain amount of time. If it's 8 months, 12 months, I don't remember. But interest rates right now range. What did you say you were around 3, Melody? That's about what they're running. 2.875 to 3.25 for owner occupied is what I'm seeing both on purchases and refinances.
Yes.
So it doesn't, if that helps, I don't know.
Yeah, and actually Jeanine would be the best answer because she actually does mortgages now for a living. I forgot about that. My apologies.
That's all right.
So,
well, yeah, it's a new thing that I did a long time ago, and somebody asked me to come back, so I'm back, and that's what I do all day is underwrite credit, income, property. I just finished looking at an appraisal for all over the state of Florida. Our company is based in Miami, but we have loan officers all over the state. Actually, we do Texas and California too, but I don't see too many of those loans. So anytime you have a question, I'll see what I can do to answer.
Awesome.
Excellent, thank you. That's great information. And yes, those closing costs, those pesky closing costs could always change how you look at interest rates, especially when it comes to refinancing. But everyone's situation is different. So looking at your financial situation, your financial life is important, and what your goals are moving forward. If you need financial advice or financial goal setting, Michael's the person to go to. Definitely, definitely, definitely. Thank you so much. I'm going to stop recording, and I look forward to all of you guys being here next week.